that you're able to see? Are you able to see what I'm recording? Are you able to see what I'm just displaying? Please confirm by typing Y for yes. Just confirm by typing Y for yes, and then we'll be able to proceed. Is ready to pair. Okay, good. That is very good. Thank you for confirming, Asante. Now, team, we managed to introduce this topic number 3, and this is a topic whereby we see the financing decision. So every organization require finances, and we say that we need to have a mix of finances, that is debt and equity. That mix is very important for the company's operation, whereby as a manager, you need to identify what would be the best combination, what would be the best mix. Then we looked at the factor that we can consider when making financing decisions. And one of the main factor, in fact, you can remind me by typing it down there. Just remind me, what are some of the factors to consider when you want to make a financing decision? When you want to make a financing decision, what are some of the factors that you can consider? Maybe you can just write 1 or 2 under the chat so that we are able to continue. This is just a reminder of what we had said. It's just a reminder of what we had said. And the first thing is amount. How much do you need? How much do you need to borrow? How much do you need to finance your business? How much do you need to finance your business? I can also mention of the time period that it takes for you. Yeah, thank you, Janet. Time period that it takes for you to do what? To pay that loan. What else did we say? We said about security. Do you have the guarantor? Do you have the title deed, the asset to be used as the collateral? So we can go through them very fast. This is highly examinable. Our amount, how much money business need, ownership and the size of the business. At this point, you look at, is the business yours? What is the size of the business? We say that you cannot go and borrow an amount which is more than the asset base of that business. If the asset base of your business is 10 million, you cannot go and borrow 50 million. That is not, it is not proportional. Then availability of security. Do you have security title D? Do you have a logbook? If you want to use a logbook, those items are very important. You have to consider that. Cost of finance. This is the interest charged on that debt. Company gearing level. How is your debt as per that time? How is your debt as per that time as a company? When you talk of gearing level, we are talking of the level of debt. The level of debt, the debt that you borrowed maybe from somewhere else. How much is that? That still is a factor that you need to consider. Purpose of the finance is also the key. And then we have the sales stability of the company together with the competitiveness of the industry. Very, very important. Very, very important. And that one will really help you to do what? It will help you to at least make an informed decision. So those are some of the things that we have. Then we have the sources of finance for enterprises. We have both internal and external. That's the major part that we form sources of what? Finances, internal and external. And I want to welcome Janet to lead for us that part of internal. So just unmute from your end, Janet, and take us through that part very fast. Ama tulikuwa tumepitia hiyo nini? Bado, not yet. Don't think we had done that. I don't think we had done that. So Janet, just unmute from your end and just take us through that part. Janet. If you're in a position, you can just do that. If the environment does not allow you, you can just type and tell us not possible. All right, just proceed. Internal very fast. So first of all, look at the definition. Continue.
Internal sources are those sources which are generated within the business. It means the internal sources provide funds from the operation of the business. This consists of retained earnings that is profit after interest and tax plus provision of depreciation less cash dividends, provision of depreciation, provision for depreciation internal fund in the sense that it is a charge to the income statement and does not involve outflow of cash. Depreciation is allowable deduction for tax purpose, is therefore benefits the company with tax savings. Depreciation reduces the earning attributable to the ordinary shareholders, and consequently the cash dividend payable. C. Sell and lease back, selling of surplus inventories, applying back of profit, accelerating collection of receivable, adjustment in working capital. If the firm is overcapitalized, it can reduce its investments in current assets and release some cash previously tied in the current assets.
All right, that is very good. Internal sources. We know internal sources. They are form of equity, and the component are retained earning, ordinary share, reparation. We have all those. Those are sources that come from, or the amount of money that come from the business are generated from the business itself. When you talk over sale and leaseback, is whereby you are having an asset, but maintaining that asset is difficult as a company. What happened? You sell the asset and then you lease it back. So it is cheap that way. Those are some of the decisions that you make. Then you can sell the surplus inventories, round back of profit. You whatever that you get, you take it back to the business. Those are some of the internal sources. Yes, Janet, just continue with this part. External. Janet alikuwa amemute already. Yeah, just unmute and continue with that part. And then we'll have David.
External sources of finance are those sources where finance is obtained from owners or creditors. This consists of 1. Ordinary share capital, preferred share capital, debentures, trade credit, hire purchase, and loans from banks and other institutions.
Okay, thank you so much. Janet, for taking us through that part. So when we talk about the external sources, of course, we understand tuko na loan, tuko na ordinary share, tuko na preference share, tuko na trade credit, hire purchase loan from the bank. All those are external sources. Then we have the long-term source of finance. And at this area, this is highly examinable. External sources, long-term sources of finance. Long-term sources of finance. Long-term sources of finance are funds that are needed over a longer period of time. And this longer period of time, tulisema, miaka ikue more than one. Generally, more than 10 years. Of course, 2 to 10 to 20 years. The reasons for undertaking long-term finance are generally different to those of relating to the short-term financing. Long-term financing may be classified into 3: equity finance, venture capital, debt financing. So we want David to take us through the equity financing, and we'll be able to look at the characteristics of equity. We'll be able to look at the characteristics of equity so that we are able to understand better. So David Maritam, you can just take us through that part of equity. Just proceed.
Okay, equity financing, which is ordinary share capital. This is raised from the public from the sale of ordinary shares to the shareholders. This finance is available to limited companies. Ordinary share capital carries a return that is variable, ordinary dividends. These shares carry voting rights and can influence the company's decision-making process at the annual general meeting. These shares carry the highest risk in the company, that is high securities, documentary, documentary claimed to.
Okay,
Because-
okay. Thank you, David. Don't mute. Don't mute. Don't mute. Now, Tim, whatever that examiner will ask you from this part is the characteristics of ordinary share, also known as equity financing. Equity financing. One of the characteristics is that these have voting rights. They carry voting rights. Very important. The shares or these shares carry voting rights. That is one of the characteristics, and they can influence the company decision making. You know, we say that audience shareholder, they're the owners of the firm. They are the owners of the firm. Remember, this gives us permanent capital. It gives us permanent capital as compared to debenture. Debenture lazima utalipa. You have to pay the principal together with the interest. But this one gives the company permanent capital. And that's why these guys will, they don't have a claim. In fact, their claim is residual. They are paid at the end. If the company goes to liquidation, these guys are paid at the end. Sikampuni yenu, then pay the creditors first, then pay you preference shareholders, and then whatever that remain, you can share. You can share. Very, very important. So these shares carry the highest risk in the company. But you'll be able to see that even if they carry the highest risk, most people prefer them. Most people prefer them. David, you can continue.
Okay, these shares carry the highest risk in the company because of the following: uncertainty of return, cannot ensure a refund, have residual claims. There is claim last on profit, claim last on assets. However, these investments grow through retention. Reasons why ordinary share capital is attractive despite being risky.
Aya, hii utaletewa kwa mtihani, so be very keen, just pick 2 or 3 points. Understand? All right, continue.
1. Shares are used as securities for loans, that is a compromise of the market price of a share. 2. Its value grows. 3. They are transferable at capital gain. They influence the company's decisions. Carry variable returns, that is good under high profit. Perpetual investment, thus a perpetual return. Such shares are used as guarantees for credibility. Advantages of using ordinary shares capital in financing.
Advantages.
1. They facilitate projects, especially long-term projects, because they are permanent. 2. Its cost is not a legal obligation. 3. It lowers gearing level, that reduces chances of receivership and liquidation. 4. Used with flexibility without preconditions. 5. Such financials boost the company's credibility and credit rating. 6. Owners contribute valuable ideas to the company's operations during its by professionals.
Okay. Thank you so much, David, for taking us through that part. I hope people have been able to even pick or write down some of the points under the reasons why ordinary share capital is attractive despite of being risky. You cannot forget a point like its value grows. You remember when we were looking at topic number 5, this point really came up very clearly. Topic number 5. Valuation of ordinary share, its value grows, and that's why we have dividends. Current dividend, we have expected dividend. So you find that ordinary share value grows. They are transferable at capital gain. What is capital gain? You find that you've bought some shares today at a certain price, for instance, 100 per share, and then tomorrow this share price goes up to 115. You can transfer them. You can transfer them at that capital gain. You're having a capital gain of 15 shillings per share. You have a gain of 15 shillings per share. So they are transferable at capital gain. Influence the company's decision. That one we said. Carry variable return and perpetual investment. Perpetual investment, that means these investment remain into foreseeable future. Such shares are used as guarantee for credibility. If you're a shareholder, you have a say in that company. Advantages is something which is very important as well. They have lower gearing level, used with flexibility. It costs not legal obligations. Not a legal obligation, by the way. If we compare this with the debenture, if you default, there is consequences. For this one, we don't have something of the sort. And then we go to the second one, which is the venture capital. It's another long-term source of finance. And somebody who is going to take us through these is Mary. Is Mary available here? Mary, you can just take it up. David, thank you so much. Maybe you can just unmute and take us through the venture capital. Let's know who is the venture capitalist, what is venture capital, like that. And if you're not in a position, you can just chat it up there so that you're able to give to somebody else. Remember, through this, you are able to see it clearly. Able to see it. So Mary, you can unmute from your end and then take us through that point.
Hello, venture capital. This is a form of investment in new small risk enterprises required to get them started by specialists called venture capitalists.
Thank you, Mary.
Venture capitalists.
I wish, Mary, are you able to hear me?
Yes.
I will wish that somebody may pick that statement, that statement that you've read, defining the venture capitalist. I wish somebody is speaking that. Please proceed.
Venture capitalists are therefore investment specialists who raise pools of capital to fund new ventures, which are likely to become public corporation in return of. Why? Malimu, kindly let me assign this to someone else.
Okay, no worries. Let me assist you. So team, I want you to understand this, that examiner may bring the two terms. What is a venture capital and who is a venture capitalist? A venture capital is the investment itself, whereby those people with the huge amount of money, they have muscles. When it comes to money, they come and they want to support the small enterprises. They want those small enterprises to thrive and to grow. All right? On the other hand, the venture capitalist is the person himself. Of course, they'll come in groups. And they understand the business perspective. From the scratch, they are able to give you ideas and resources. We will see their position in that venture or that entity. We will see what they take care of. So new venture, which are likely to become public corporation in return for an ownership interest. Venture capitalists will only invest in a company if there is a reasonable chance that the company will be successful. So they don't just come in. Like that. They want to be sure that this business has got a going concern trace. Their publicity materials state that successful investment have the three common characteristics. So this is what they look at. Before they come in. They look at there is a good basic idea, a product or a service which meets real customer need. Whatever that you are venturing in, does it really meet the customer need? Is it really fulfilling what maybe the society require? right? That is the point. There is finance in the right form to turn the idea into a solid business. There is also commitment and drive of the individual or group and the determination to succeed. Attributes of a venture capital. What does signify them? Equity participation. So they're going to contribute in equity. Long-term investment. Yeah, they must also come up with the idea of which investment should be undertaken for long-term. Participation in management. Wow. When they comes in, now the business does not become yours alone. Yes, you have to give them some parts of your business, or they'll be in part of the management, A lot of venture capital in the economy. One, the types of venture capitalists, the type of venture that capitalists might invest in will involve business startup, business development, and management buyout. What is the difference between management buyout? This is also another question you can find. What is the difference between management buyout and management buy-in? Team management buyout simply means the managers in that business are able to acquire the business. Management buyout. Management buy-in is the managers from outside who come and acquire the business. So buyout, manager who are within acquire the business. Management buy-in, managers who are coming from the outside to buy the business. I hope that is clear. Good. Funding venture capital. How do we go about that? The institution will want to an equity stake in the company. It will need convincing that the company can be successful. That's when we said it may want to have a representative appointed to the company's board to look after its interests. Yes, they must have a proxy. We call them proxy, a representative. Yeah, they want to own, they want to feel part of, because the ideas have been utilized in that venture. Public attitude. Those are some of the significant growth in venture capital, which have contributed to the same public attitude. And this is specific to developed countries. Public attitude, okay, it's positive. Dynamic financial system. We have government support, establishment of venture capital institutions. Then we have the growth in the number of management buyouts, which have created a demand for equity finance. Then we have a problem, our constraints of venture capital in developing country. Here we've chosen an example of Kenya. Kenya is a developing country. It's not a first world country, though we are getting there. We're getting there by getting to Singapore. Lack of rich investor in Kenya, hence inadequate equity capital. Inefficiency of stock market. Infrastructural problem. Lack of managerial skill on part of venture capitalists and owners of the firm. Nature of the small businesses in Kenya. By the way, small businesses in Kenya will have the three nature that are highlighted below. Large multinational corporation. These are established firms and can raise funds easily. Haya, hiyo ni moja. So they don't require venture capitalists to come in. They can stand on their own. They have funds. Asian-owned small businesses. They are family-owned, hence do not require interference of venture capitalists because they are not ready to share profit. You can imagine. Yes, you have your business pale, these people come in. Now you'll start seeing the proxy. They have somebody in the bond. So you're not now enjoying the profit alone. Those businesses are called Asian-owned small business. They are in Kenya. African-owned business need venture capital but have little potential for growth. Very little potential for growth. More so ni hizi vibanda. Naona hiyo unaweza sema mfano mzuri ni hiyo ya vibanda. Very, very important. So focus on low risk venture, conservative approach by the venture capitalists. You remember under the topic number 9, we were able to look at conservative approach. By the way, conservative approach class, it was financed by, let me see those who can remember. Conservative approach, it's financed by, tuone wenye wanakumbuka. Conservative approach is financed by, and by the next person to guide us or to take us through will be Dennis. The next person will be Dennis to take us through. Short-term financing. Let me remind you and always make sure that you keep on checking. Delay in project evaluation and lack of government support and inefficient financial system. Class, this point or this is highly examinable. This is highly examinable. Highly examinable. So kindly check that. Are we all together? Please confirm. Confirm that we are together by typing Y for yes. So confirm that we are together by typing Y for yes, and then we'll be able to continue. So then we shall be having Dennis taking us through that other part. So somebody is confirming. Just confirm that we are together by typing Y for yes. And if you have a question, this is the time that you can ask the question. Giving you 1 minute. Giving you 1 minute. Are we together? Y for yes, that's enough for me. Roy is confirmed. Martin, okay, Vincent, right, that's very good. That's very good. That's very good. Are we together? Are we together? Are we together? Are we together? We together? We together? Great, great, great. Let's go to Dennis. Dennis, let me look at Dennis here. Disadvantages, by the way, let me finish the disadvantages, then we go to debt. Dilute ownership position of a farm and dilute control of a farm. Yeah, immediately you bring them, the ownership is diluted, so you find that you'll be sharing the profit and dilute control. Even the control is not just yours alone. You have to keep on doing what? You have to keep on referring to the venture capitalists. Great. So Dennis, I hope you're ready. I want you to take us through these other parts of debt finance. We all know what is debt and what it entails. Yes, Dennis? You can just unmute and take us through that part. All right, great.
All right. I hope you can hear me.
Yes, you're very clear. Thank you.
All right, thank you. Under debt finance, we are going to define debt finance. Debt finance is a fixed return finance as the cost stroke, that is in bracket interest, is fixed on the par value, bracket face value of the debt. Debt finance is limited to 1, value of security. Number 2, liquidity situation in a given country. It is ideal for companies where gearing allows them to raise more debt and thus gearing level. Loan finance. This is a common type of debt and is available in different terms. Usually short-term, medium-term loans vary from 2 to 5 years. Long-term loans vary from 6 years and above. Conditions under which loans are ideal.
Thank you, David.
Number 1.
Just a minute, David. Just a minute. Just 1 minute. Now, Tim, under this section, we're being told of things or the characteristics of a company who is able to get loans. The characteristics of a company who is able to get loan. Continue. Just continue. David, Dennis, I'm unmute. I'm a mute. Dennis, continue. You can unmute. Yeah.
Okay. Conditions under which loans are ideal. Number 1, when the company's gearing level is low, bracket the level of outstanding loans is low. Number 2, the company's future cash flows, bracket inflows and their stability must be assured. Number 3, economic condition prevailing. The company must have a long-term forecast of the prevailing economic condition. Number 4, when the company's market share guarantees stable sales. Number 5, when the company's anticipated future expansion programs justify such borrowing.
All right, great.
So
Continue. Uh-huh.
we're going to advantages of using debt finance.
Mm.
Number 1, interest of debt is a tax allowable expense, and as such, it is reduced by the tax allowance. Number 2, the cost of debt is fixed regardless of profits made, and as such, under condition of high profits, the cost of debt will be lower. It does not call for a lot of formalities to raise, and as such, it's ideal for urgent ventures. It is usually self-sustaining in that the asset acquired is used to pay for its cost, i.e., leaving the company with the value of the asset. In case of a long-term debt, amount of loan declines with time, and repayment reduces its burden to the borrower. Debt finance does not influence the company's decision, since lenders do not participate at the AGM, that is annual general meeting. Disadvantages. Number 1, it is a conditional finance, i.e., it is not invested without the approval of the lender. Number 2, debt finance, if used in excess, may interrupt the company decision-making process when gearing level is high. Creditors will demand a say in the company. Number 3, it is dangerous to use in a recession, as such a condition may force the company into receivership due to lack of funds and service the loan. It calls for security which are highly negotiable or marketable, thus limiting its availability. It is only available for specific ventures and for a short term, which reduces its investment in strategic ventures. The use of debt finance may lower the value of the share if used excessively. It increases financial risk and require rate of return by shareholders, thus reduce the value of shares.
Yeah, that's better. Thank you so much, Dennis, for taking us through that part. Very, very important
Yes.
part in regard to debt. So, team, you need to always remember the conditions under which loans are ideal. The conditions under which loans are ideal. The gearing level of the company should not be high. Hapo utapata loan. The cash flow should be promising. Economic condition lazima ikuwe sawa, whereby we don't expect political interference. Economy should be stable. And then we have the company market share guarantees stable sales. So if we expect that sales will increase next year, we expect it to happen. Those are very important. And also we have the advantages of the same and disadvantages. If you pick like 3, you're good to go. If you pick like 3 advantages, 3 disadvantages, you are good to go. Then we have the differences between debt finance and equity finance. This is also a very common question in exam. And as we said, if you ask a question to do with a differentiation, you draw a table like this. You draw, okay, not necessarily a table, a T table. And you just have a T form of a table, whereby you are having your one item on this end and the other side, the other item on the other end, like equity finance, then debt finance. It is a permanent finance since it is raised by the owners of the company. That one we said, yeah. When you talk about equity, this is the owner's money. It is the owner's money. So it's a permanent finance. On the other side, it is redeemable. You have to refund back. You have to refund back. And in fact, remember when you're refunding, you're not refunding the principal alone. No, the interest is attached upon maturity since it is externally sourced. So it is another person's money. Return paid when available, that is return paid when available, that is not, it's not guaranteed for shareholders to earn dividends. By the way, it's not a guarantee. It's not a guarantee. If the company does not make profit, is there anything to earn, to get as in form of dividend? No. Ikiwa sawa, lakini kama hakuna, it is a fixed return capital. Yes, if you agreed that you're going to pay 10% interest on the loan for a certain period of time, you must pay. It must be paid. Dividends are not tax allowable. On the other side, interest on debt is tax allowable, and that's why debt are the best source of financing. Unsecured finance, debt you must have to secure. You must secure. Lazima usikie unaitishwa sijui guarantors sijui nini, unaitishwa hizo logbook, lazima it's secure. Carry voting rights, the other one no voting rights. Reduces gearing ratio, increases gearing ratio. Hapo inamaanisha inapunguza mambo na deni. Reduces gearing ratio because this is a owner's capital. So mambo na deni inapunguka. On the other end, mambo na deni iko. No legal obligation to pay. The other one, ukikosa kuripa, if you default, legal obligation is there. You can even be taken to court. People can come and auction your items, and it can be very embarrassing. So as an accountant, you need to be very keen as a profession. Has a residual claim, carries a superior claim. Yes, debt must be paid fast. You pay creditors fast. You pay your suppliers fast. When the company is going into liquidation, when the company is closing its door, you have to pay your creditors fast. Lazima walipwe kwanza. The preference shareholder walipwe kwanza. And then ingine, kama iko kitu sawa, kama hakuna sawa, waende wakienda. Owner's money, the other one is creditors finance. Class, please confirm again that we are together up to that point before we welcome Anastasia to take us through these other part of similarities. Please confirm that we are together. And Anastasia, you can be unmuting. You can be unmuting so that you can take us through these other parts. Kindly. Good. Karibu sana. Asante. Similarities, and then we continue. Asante.
Similarities between preference and equity finance. A, both may be permanent if preference share capital is redeemable, in bracket, convertible. B, both are naked or unsecured finance. Both are traded at the stock exchange. Both are raised by public limited companies only. Both carry residual claims after debt. Both dividends are not a legal obligation for the company to pay.
All right. Continue with the differences between the two.
Differences between preference and equity finance. Ordinary share capital has a residual claim both on asset and profit. Preference has a superior claim. Ordinary share reduce the gearing ratio. Preference increase the gearing ratio. Ordinary share variable dividend, hence growth over time. Preference fixed dividend, hence there is no growth. Ordinary permanent finance, preference usually redeemable. Ordinary easily transferable. Preference not easily transferable. Similarities.
Continue.
Similarities between debt and preference share capital. Both have a fixed return. Both will increase the company gearing ratio. Both are usually redeemable. Both don't have a voting right. Both may force the company into receivership. Both have superior claims over and above owners. Both are external finances. There's no growth with time.
All right, great. That's very good. Anastasia, asante sana. I think in our first mock, you managed to do a question that was asking about the characteristics of preference shares. So those questions are brought from this area. Therefore, let's be very keen on that part. Asante sana, Anastasia, for that. Asante. All right. Okay, we have Royce raising up. Liz Kamau has raised her hand. So Royce, you can unmute and just proceed. Royce, just unmute and maybe contribute.
Okay, good evening.
Evening to you. How are you?
I'm fine.
Great.
Okay, I have a question
Yes, please.
on similarities between preference shares and ordinary shares.
Preference share and ordinary share similarities here.
Yeah.
This is debt. This is debt. Preference share and equity. Yes.
We are told that in number 5,
Number
E,
5, that is E, both.
we are told that both carry residual claims after death,
Yes.
but in differences between preference and ordinary shares,
Yes, Papa.
we are still told that ordinary shares, they have residual claim and preference shares have superior claim.
This is the first one, Hapa.
Yeah.
Has residual claim. Okay, acha tuone. Thank you. This is Royce. All right, just a minute tuone hapo. Kata. Has a superior claim, sawa sawa. All right, great. Both carry residual claim after death. Okay, hapa kuna after death, all right. And has a residual claim both on asset and profit, has a superior claim. Okay, nataka tuone tofauti of these. Both carry residual claim. Haya, equity iko na residual claim, but now has a residual claim. So unaona iko na residual claim. So hii ni superior, hii iko on the asset and also profit. This one, it has got a superior. That means if we count on debt ndio inaanziwa kwanza, then tunafuata preference share tunawalipa, alafu ordinary share wako pia na claim, they can claim, but now at the end pale mwisho on asset, kama kuna maasset ziko, kuna gari iko pale, wanagawana hizo vitu zote, ka profit kidogo imebaki, but hawa ni wa mwisho. Yes, they've got a residual claim after debt. Zote hizi zitakuja after debt, hizi mbili after debt. So tunapea creditors kwanza, wanapata mali yao, alafu tunaenda kwa preference share and then tunakuja kwa our ordinary share. Lois, is it making some sense? Lois?
Yes, it is.
All right.
Yes, it is.
Okay. Yeah, Lois, don't mute. Just take us through this part. This part of why it may be difficult.
Okay. Why it may be difficult for small companies to raise debt finance in Kenya. Number 1, lack of security. Number 2, ignorance of finances available. Number 3, most of them are risky businesses as there are no feasibility studies done. Into brackets, chances of failure have been put to 80%. Number 4, their size being small tends to make them unknown. For example, they are not a significant competitor to the big companies. The next one, cost of finance may be high. Their market share may not allow them to secure debt. Small loans are expensive to extend by bank, i.e., administration costs are very high. The last one, lack of business principles that are sound and difficult in evaluating their performance.
All right. Some of the solutions that we can have.
Should I continue?
Yes, please. Yes.
Okay, solutions to the above problems. Number 1, there should be diversification of securities, e.g., to accept guarantees. The second one, education of such businessmen on sound business principles. Number 3, the government should set up a special fund to assist the Juakali businessmen. Number 4, encourage formation of cooperative societies. The last one, to request bankers to follow up the use of these loans.
All right. Thank you so much, Royce Kamau, for that. So, team, this
Yeah.
is where we apply such questions. You apply application. Ndio maana tulisema, please, if examiner asks you about any theory question, please don't leave a blank space. Don't leave a blank space. Answer the question. And we said we don't have specific answer when it comes to theory. Si kama hesabu. Theory sio kama hesabu. We don't have specific answer. Even from your answers, we add in our marking scheme. Imagine from your answers, tunaongeza our marking scheme. What does that mean? You may give a point that we did not have in the marking scheme. So never doubt yourself. At this point, doubt tushaondoa. Everything, kama umesoma swali vizuri, if you read the question very well, you've understood the question very well, please proceed and provide the answer. Your mind is magic. Hey, it gives you what you have understood of what you've given it. It will be able to produce the correct answer. So you believe in yourself. Anytime you get a question, a theory question, kindly make sure that you at least answer something. Short-term sources, we have short-term sources of finance. Of course, you know short-term go for a period of less than 12 months. Sometimes they go for up to 3 years. Okay. These sources help for funding shortage in working capital. These sources should not be used to finance long-term investment. They include bills of exchange of draft financing, trade credit, factoring, credit card financing. Najua kuna wenye wako na credit card saa hii, wewe ni kuswap tu kama ni school fees, kama ni fuel, you just use the card. Ikiisha una top up and then una continue to kuitumia. Invoice discounting, higher purchase, and then we have freeze financing. Now team, sometimes the examiner may ask you what is the bill of exchange. All right, overdraft financing, don't go too far to check that. Hiyo ni kama Fuliza. Of course, I advise my student to unsubscribe from Fuliza. You unsubscribe from Fuliza. Why? It is too expensive. How much does Fuliza charge you as interest every day? How much? Somebody? Wenye amefuatilia mambo ya Fuliza vizuri. How much does it charge you? Cha tuone, let's do some analysis kidogo. How much does it charge you? It's a 1%, right? 1%, is that correct? 1%, is that correct? Ama sisi hatuyuko kwa Fuliza. In fact, kama uko kwa Fuliza, just unsubscribe now. It's too expensive. It is 1% per day. How much percent do we have per year? If we translate that per year, itakuwa ngapi? Itakuwa 365 ama 365% per annum. Hata ni bank gani inakucharge interest ya hiyo kiasi? Ni bank gani? Just jiulize tu. Only that sasa hii inakufanya ukuwe ni kama uko nayo lakini huna, na inakuibia pande ile ingine kwa wingi. Unaona? Inakuibia kwa wingi bila wewe kujua. So this is very, very expensive. Yes, it's convenient, inakufanya ukuwe at a comfort zone. Anytime you can Fuliza, anytime you can do anything because iko pale wanakupatia, you have zero money but you can do something. My friend, this is the most expensive loan. We call it overdraft financing. Tutaiangalia, utaulizwa ni nini. Trade credit, hiyo ni ile ya kawaida. factoring, credit card financing, hiyo ya card tumesema, examiner anaweza kuuliza. Now we want us to just check, we can check bill of exchange, overdraft financing, maybe disadvantage and advantages. We check like 5 or 4, and then we move to the next part. So at this point, I welcome Esther Mtash to take us through the bill of exchange, and we'll be able to understand what it stands for. It's something that we write. Unaandika, andikia somebody. Yes. Yeah, Mtash, Esther. You can unmute from your end and take us through that part. That would be very good. Mtash, Esther. Give you some seconds to do that. Are you able to unmute? Mtash is not able to unmute. So what we do is to welcome somebody else. We shall give Mtash time yake. Am I able to pick another person here? A minute, Mtash. Let's go to Dima, or brother Dima. Dima, how are you? Are you able to unmute and take us through? Dima Dabaso. Galgalo. Dima, are you with us? Mutuse, are you with us? Dima, are you with us? Aha, tukichukua muda kidogo, tunaenda kwa the next person to save time, you know. To save time, Mary. Stephen, our friend, you can also do the same. Stephen.
Good evening, team.
Good evening to you.
Hope you are doing well.
Very fine.
Yes, bills of exchange. Bills of exchange are sources of finance, in particular in the export trade. A bill of exchange is an unconditional order made in writing addressed by one party, that's the drawer, to another party, that's the drawee, requiring him to pay a specific sum of money at a particular time. The commonest types of bills of exchange used in financing are accommodation bills of exchange. For a bill to be a legal document, it must be 1. Drawn by the drawer, 2. Bear a stamp duty, 3. Acceptable by the drawee, 4. Mature in time. It is used to raise finance through discounting it, negotiating, or giving it out as a security. Advantages of using a bill of exchange advantages of using a bill as a source of finance. 1. They are faster means of raising finance on instances when the drawer is credible. 2. Is highly negotiable or a liquid investment. 3. Does not require security. 4. Does not affect the gearing level of the company. 5. It's unconditional and can be invested flexibly. 5. It is usable as a source of finance, or it's useful as a source of finance to finance working capital. Next, it's used without diluting the capital. Scroll up. Yeah, that's the bill of exchange.
That's the bill of exchange. That's the bill of exchange. Thank you so much, Stephen, for that. Team, I hope this part, when you're unafanya company law, si iko kwa company law. Iko company law, sio? Ile ilikuwa inaitwa business law pia ilikuwa nayo. Company law, when you're unafanya company law, si kuna bill of exchange. And this is a question which is common unaulizwa kwa company law, the component ama what should be done for a bill of exchange to be a legal document. Yeah, lazima wafuate hizi procedure. Lazima wafuate hizi procedure. So it's a legal document, legal written document. Very important. overdraft, hii mambo ya fuliza hii mambo ya fuliza. An overdraft is an extension of credit from a lending institution where an account reaches zero. Wakati uko na sufuri, you are able to have at least money ya kufanya nini. So advantages ni ati it is useful in financial crisis which an accountant cannot forecast due to abrupt fall in profits, thus liquidity problem. All right, so since somebody, Mwalimu, we also request you to share the notes in our WhatsApp. You have them, so you have these notes. Royce and Steve, you can share the notes. Yeah, you have these notes. Somebody will share them. Have these notes. Hizi nadhani ilikuwa nimezituma. All right, thank you, Mary. All right, now when you go to disadvantages, it is expensive as the interest rate of the overdraft are much higher than bank rate. Much higher. Tumeangalia na nyinyi tukaona ni 365% per annum. So Vincent, can you take us through the trade credit factoring? Let's just look at the factoring, bond refinancing, whereby uko na deni alafu ilikuwa expensive, unachukua ingine yenye sio expensive, unalipa ile expensive alafu unaendelea kulipa. Yeah, so you save some interest pale. Aya, Vincent, are you able to unmute and take us through before we go to Vayora? Vincent, notable Vayora, utawapea baadaye.
I'm okay.
Okay. Yes, Vincent. Yes, please proceed with the factoring.
Factoring.
Yes.
It is where data is sold for immediate cash to a factor who charges a commission. When the factor receives each batch of invoices from his client, he pays about 80% of its value in cash immediately. Factoring can result in a savings to management in the form of savings in bad debt losses, salary cost, telephone and postage etc. Aspect of factoring. The main aspect of factoring include the following: 1. Administration of the client's invoicing, sales accounting and debt collection services, credit protection for clients' debts, where the factor takes over the risk of loss from bad debt and so insures the clients against losses. This is known as a non-recourse service. C. Making payment to the client advances of collecting debt. This is sometimes refers to factor finance because of the factor is providing cash to the client against the outstanding debt.
All right, advantages are the same.
So advantages of factoring. The benefit of factoring for a business customer include the following: 1. The business can pay its suppliers promptly and so be able to take advantage of any early payment discount that is available. Optimum inventory level can be maintained because the business will have enough cash to pay for the inventories it needs. 3. Growth can be financed through sales rather than by injecting fresh external capital balance. D. The business gets financed linked to its volume of sales. In contrast, overdraft limits tend to be determined by historical balance sheets. The manager of business do not have to spend their time running its own sales department and can use the expertise of data management that the factor has. Disadvantages of factoring. The cost of factoring will reduce the profit margin of the company. It may reduce the scope of borrowing as books debt will not be available as a security. It may damage the reputation of the company with its customers. Factor may want to vet the customer, hence influence the way the firm does its business.
That is very good. That is very good. And I hope you're able to see. Okay, just a minute, Vincent. All right, great. Thank you so much, Vincent or Chill. Asante. Now, we're able to see that when you talk about factoring, debt are sold for immediate cash to a factor who charges commission. Debt are sold for immediate cash to a factor who charges commission. I continue. When the factor receives each batch of invoice ya deni yenye inauzwa from his client, he pays about 80% of his value in cash immediately. What happened? There is a 20% which is remaining. Hata yeye lazima ako biashara. So the person is trying to remove burden from your end. And then anabaki na ile burden, but ata what? Atagoja. The person will wait. Factoring can result in saving to management in the form of saving in bad debt losses, salary cost, telephone and postage such. So at advanced level, you're going to look at bond refinancing or bond refunding, which will help you to get into more details on this. Then credit card financing, walikuwa wanaita credit money ama plastic money. So this is a finance of a kind whereby a company will make arrangements for the use of the services of credit card organization through the purchase of credit cards in return for prompt settlement of bills on the card and a commission payable on all credit transformation. Reason behind the first development of this finance or the plastic money in Kenya. Why is this growing very fast? Why is it growing very fast? Watu wanataka card. Mambo ya kwanza ni crime. Crime is at high level. So high incidence of fraud by dishonest employees has been reasonable for development of this finance at its minimum, or as it minimizes chances of fraud because it eliminates the use of hard cash in the execution of transactions. So bribe. Unajua bribe inaletwa sana sana juu ya ukiwa na hizi cash, hard cash money. Risk associated with the carrying of huge amount of cash for purchase, which cash is open to the theft, and misuse has also been reasonable for development of this finance. Credit card have boosted the credibility of the holders company, which enable them to obtain trade credit under conditions which would have otherwise been difficult. Of late, Kenya has experienced emergence of a right, middle, and high income groups, in particular professionals who tend to use these cards as a symbol of status. Niko kadi. Though this is ile kadi watu wanasema wako na kadi, hapana, hii unacharge na pesa, wewe kazi yako ni kutumia, ikisha una replenish status in execution of day-to-day transaction. The card have been used by financial institutions and banks to boost their deposits and attract long-term clients. Royal Card Finance, Standard Chartered. So unapata kwamba ukiwa na kadi unataka uende pale. Hata supermarkets wako na kadi. So inaku-grow kwao kwa sababu kuna zile point unapata pale na hiyo inakufanya ukue the loyal customer. A number of companies and establishments have acquired such cards as a means of settling their base under certain time. So class, kindly check this. This is something that can be brought to you. You can be asked, we pata pointi zako 2-3, and then mambo inakuwa mzuri zaidi. Great. Are we together? Are we together up to that point? Are we together? Confirm that we are together. Before we continue, I want to give Viola to maybe read some of the limitations and disadvantages of this. In fact, we have the limitations. So Viola, it's your turn now. You can just unmute and take us through that part. Viola, are you able to unmute? If you're not able, we shall go to Waithaka. Shall go to Waithaka. Waithaka, is your turn. Oh, okay.
Okay, I'll be taking limitations of credit cards as a source of finance.
Yes.
Okay, good evening, team. So, limitations of credit cards as a source of finance. One, these cards lead to overspending on the part of the holder and as such may disorganize the organization's cash budget and cash planning. Number two, limited as to the activities they can finance as they are ideal for financing working capital items and not fixed assets, in which case they are not a profitable source of finance. 3, they are expensive to obtain and maintain because of associated costs such as ledger fees, registration, insurance, commission expenses, renewal fees, and etc. 4, it is a short-term source and is open only to a few establishments, in which case a company can obtain goods and services from those establishments that can accept them. 5, entail a lot of formalities to obtain. 6, they may be misused by dishonest employees who may use them to defraud the organization of goods and services which may not benefit such organizations. 7, credit card organization may suspend the use of such cards without notice, and this will inconvenience the holder who may not meet ordinary needs obtained through these cards.
Thank you so much, Waithaka, for that. So, team, that area is very important. So, when you're revising, kindly try to take much time on that. Try to take much time on that. So, during your own free time, please check on the invoice discounting, the higher purchase for the leases. Allow us to go through the leases. We know that lease is a contract between two, a lessor and the lessee. Who is the lessor? The owner of the asset. Who is the lessee? The person who has gotten the right to use the asset. The lessor and the lessee. We have two types of leases, that is operating lease and finance leases. Under operating leases, we find that these are rental agreement between the lessor and the lessee, whereby the lessor supply equipment to the lessee. The lessor is responsible for the servicing and maintaining the leased equipment, and the period of the lease is fairly short, less than the economic life of the asset. So that at the end of the lease agreement, the lessor can either lease the equipment to someone else and obtain a good rent for it, or sell the equipment as a secondary. So we say that if the lessee leases this item for less than 75% of the useful life of that item, it will become an operating lease. If the lessee leases this item for 75% and above of its useful life, now that one automatically becomes what? A finance lease. So that's something that you need to understand, so that when you are asked, you'll be able to answer. So this is also found in the financial reporting. So you might have also done this. We have the advantages of this operating leases, whereby the lease equipment does not need to be shown in the leases published balance sheet. Hiyo sasa ni mambo ya file. The equipment is leased for a shorter period of its expected useful life. We have finance leases. Royce, we want you to take us through this part. Royce is taking us through this part of it. Royce. yeah, you can take us through that part and then we'll be able to continue to.
Okay,
Oh,
good evening once more.
all right.
I'll take you through finance leases. Finance leases are lease agreements between the user of the leased assets, into bracket the lessee, and a provider of finance, into brackets the lessor, for most or all of the asset's expected useful life. Suppose that a company decides to obtain a company car and finance the acquisition by means of a finance lease. A car dealer will supply the car. Other important characteristics of a finance lease: the lessee is responsible for the upkeep, servicing, and maintenance of the asset. The lessor is not involved in this at all. Number 2, characteristics. The lease has a primary period which covers all or most of the economic life of the asset. At the end of the lease, the lessor will not be able to lease the asset to someone else, as the asset will be worn out. Leases are popular because, number 1, the supplier of the equipment is paid in full at the beginning. Number 2, the lessor invests finance by purchasing assets from suppliers and make a return out of the lease payments from the lessee. Number 3, leasing might be attractive to the lessee if the lessee does not have enough cash to pay for the asset. Advantages of lease.
Yeah, continue.
Okay. Advantages of lease. Number 1, in a lease agreement, the firm may avoid the cost of obsolescence if the lessor fails to anticipate accurately the obsolescence of assets and sets the lease payment too low. Number 2 advantage, the lessee avoids many of the restrictive covenants that are normally included as part of loans. Disadvantages of lease. Number 1, a lease does not have a stated interest cost. Number 2 disadvantage, under a lease, the lessee is generally prohibited from making improvements on the leased property or assets without the approval of the lessor. If the property were owned outrightly, this difficulty will not arise.
Okay. Thank you so much, Royce, for that. So, Tim, it is always good to differentiate between a finance lease and an operating lease. Know how the lessor acts when it comes to the finance lease. Know how the lessor acts when it comes to the operating lease. So we've seen that the lessor, who is the owner of the asset, is responsible to maintain the asset in terms or in form of operating lease. Under operating lease, the person who is responsible for that asset is still the owner. But under finance lease, whereby we are leasing 75% and above of the asset useful life, we are now giving responsibility to the lessee, that the person who have gained the right to use that asset. They're the one now to do the repair, anything that needs to be done in that item. Reward also goes to them because they have leased this item for the bigger part of its useful life. And at the end of the lease, in fact, now the owner may not even have the use to that item. It is always good to remember that advantages and disadvantages of each source of finance. So we shall start with the internal source of finance. Low cost, retention of control and ownership, no approval needed, no legal obligation. That is very important. Disadvantages of internal sources of finance: limited amount of finance, lack of possibility. What are some of the advantages of short-term source of finance? Quick funds when you are in it, available even to those with hard credit, and then the flexibility of repayment. Disadvantages of short-term sources of finance: higher interest rates. Kama hiyo tumesema, inakuwa unakuta interest is a little bit high because it's a short term. The biggest limitation of these loans is that there is generally a higher interest rate associated with short-term loans as opposed to the long-term. Kama vile tumesema, Tuliza inachukua 365. It's the short-term. The short-term. It's quite expensive. Advantages of long-term sources of finance. There are disadvantages. The advantage of long-term sources of finance, moja, its capacity for high dollar capital, ideal for businesses that need large amounts of cash for massive marketing, campaign, extensive product development, and internal expansion, and other huge cost of operating in a business, a large business. A longer term repayment allows business to keep payment manageable on longer loans. Disadvantages of the same: stringent financial requirement, limited choice, collateral, extended repayment obligation. Then we have the last one, which are factors to consider when selecting the source of finance. This is highly examinable. This was from another past paper, so it was a question which came in a certain year. Therefore, it's also a question that you may expect. When recommending a financing method, consideration should be given to a number of factors. These factors are key to justifying your choice of a method, and examiner has in the past asked the student to discuss these factors in an exam question. These factors include, we have cost, the cash flow, risk, availability, maturity, control, the cost and ease of issue. Then we have the yield curve, So these factors are important, the factor that examiner may ask. So Tim, I want to give you some 5 minutes, and then we introduce topic number 3, and then we call it a day. 5 minutes for break. So by 9:39, we shall be back. But for that topic, done. For topic number 2, done. That's end. That's the end. So you might have a question. You can be using that time to type it down. If you have a question, kindly use that time to type it down. You can also use the time to take a cup of water, a cup of tea, cup of milk, a cup of mulsik, cup of porridge. You can just use that time for that. Soul team, we are back. We're back. Just confirm. You can just confirm with a thumb. Can just confirm by typing Y for yes if you're there. If you're there, just confirm. This topic number 3 is quite very interesting. It talks to us directly. We're going to look at the role of CBK, the role of Regulatory Authority of Kenya. This is a very nice topic about the financial institutions and markets. The financial institutions and market. And we say that a financial system is a network of a financial institution, financial market, and the financial instruments that facilitate the flow of funds between borrowers, lenders, and promote efficient allocation of capital. An overview is given down here, whereby we're going to define what is a financial market, and we say it's a platform where buyers and sellers trade financial assets such as stocks, bonds, commodities, currencies, and derivatives. These you cannot see them. These viazi, ama nyanya, ama nini. These are invisible. They are we call them virtual assets. And they provide a mechanism in raising capital and enable the transfer of risk. Financial markets can be categorized into primary markets where new securities are issued, and secondary market where existing securities are also traded. So you can be told to differentiate between the primary market and secondary market. Kindly note that under primary market, at that point, we issue the new securities. And the secondary market is where now those existing securities from the primary market are traded. That's the secondary market. Financial institutions, these are intermediaries that facilitate the flow of funds in the financial system. They include banks, we have credit unions, insurance company, pension funds, mutual funds, investment bank, and other entities. You understand, and you've interacted with these. Some of you are working in these financial institutions, so you understand them. Financial institutions perform various functions such as mobilizing, saving, providing loans and credit, facilitating payment, managing risk, and also offering investment and advisory services. Class, financial institutions act as an intermediary between the borrower or between the seller and the buyer. Of course, they provide finances. Financial instruments, we're going to have Janet taking us through this part of financial instrument. Janet, your turn. Yes,
Financial instruments are contract or agreements that represent financial claim or investment opportunity. They can be categorized into various types, including equity instruments represent ownership in a company, such as common stock or preferred stocks. Debt instrument represents loans or debt obligations, such as bonds, treasury bills, or corporate loans. Derivative instruments derive their value from underlying assets or benchmark, such as options, futures, or swaps. Money market instruments, short-term debts, securities with high liquidity and low risk, such as treasury bills, commercial paper, or certificate of deposit. Insurance products provide protection against specific risks, such as life insurance, health insurance, and property insurance. Nature and role of financial markets. Primary and secondary security market. Primary and secondary security markets. Money and the capital market. Over-the-counter and organized market. Derivative market. Mortgage markets and forex market. Financial market play a crucial role in facilitating the exchange of financial assets, mobilizing capital, and enabling risk management. An overview of nature and roles of various financial markets. Primary security markets. These markets is where newly issued securities such as stock and bonds are bought and sold directly between issuers and investors. Company, governments, and other entities raise capital by issuing new security through methods like initial public offering and bond offering. The primary market provides a way of issuers to raise funds and investors to acquire new security. Secondary security. The secondary market is where securities previously issued in a primary market are traded among investors. Stock exchanges such as New York Stock Exchange, NYSE, or NASDAQ, and bond markets facilitate the trading of stocks and bonds respectively. The secondary market provides liquidity and enable investors to buy or sell security after the initial issuance. Money market. The money market deals with short-term debt instruments and financial assets with high liquidity and low risk. It includes instruments with treasury bills, commercial paper, certificate of deposit, short-term government bonds. The money market facilitates short-term borrowing and lending for financial institutions, corporations, and government to manage their liquidity needs. Capital market deals with capital markets. The capital market deals with long-term security, such as stock and long-term bonds, which have maturity exceeding 1 year. It enables the transfer of long-term capital between investors and entities seeking funds for investment or expansion. The capital market facilitates the allocation of long-term capital for productive purposes.
All right. Thank you so much, Janelle, for that. So kwanza tufike hapo. Now, you'll be brought the two. Differentiate between the primary security market and secondary security market. Differentiate between the primary security market and secondary security market. So, what are you required to know? You're required to just understand when you talk about primary security market, these shares or the securities, when are they issued? When are they issued? The primary market is where newly issued securities such as stock and bond are bought and sold directly between the issuer and investor. Newly issued share. Newly. So the person who has got the security are selling them direct to the investor. When it comes to the secondary security market, now the investor who bought the security from the primary security market, now they are able to sell those securities to other people. So secondary security market, this is whereby the existing securities previously issued in the primary market are traded among investors. That's done. Ya kwanza, issuer to the investor direct. Ingine, investor sell to other investors. Money market and capital market. When we talk about money market, these are short-term debt instruments and financial asset with high liquidity and low risk. Na tumepewa example, treasury bill, we have commercial paper, we have certificate of deposit. So money market is a short-term debt instrument. Ukisha sema hivyo, alafu utuambie for example, useme tuko na TB, tuko na commercial paper, tuko na certificate of deposit, you get your marks. Capital market is a long-term security such as stock and long-term bonds which have maturity exceeding 1 year. Hapo utakuwa umegonga dipo na marks zako utapata. So utaletewa differentiate between the money market and capital market. Differentiate between the money market and capital market. So let's have David Kimayu taking us through the over-the-counter organized market and derivative. David, are you there? Okay. Let's go to Stephen. All right.
Hello.
Yes, please proceed.
So I'm starting from
over the counter.
Over the counter
Exactly.
market.
Yes.
Okay, all right. Over the counter market. Over the counter market consists of decentralized dealer based transactions that occur directly between buyers and sellers. It involves the trading of various financial instruments, including stocks, bonds, derivatives, and foreign currencies. The over the counter market provides flexibility and liquidity for trading outside of formal exchanges but may have less regulation and transparency. Organized market. Organized markets are centralized exchanges, all platforms where standardized financial instruments are traded. These include stock exchange, bond markets, the futures exchange, and options exchange. Organized markets provide transparent pricing, standardized contracts, and regulatory oversight, ensuring fair and orderly trading. We have derivatives market. The derivatives market deals with financial instruments derived from underlying assets and benchmarks. Derivatives such as future contracts, options, swaps, and forwards allow investors to speculate on price movements, entries, and manage exposures. The derivatives market provide risk management tools and opportunities for profit through leveraging market movements. We have mortgage market. The mortgage market facilitates lending and borrowing for real estate purchases. It includes primarily mortgage lenders, mortgage brokers, and secondary mortgage markets where mortgages are packaged, packaged, securitized, and traded as mortgage-based securities. The mortgage market helps individuals and businesses finance properly acquisitions. Then we have forex market. The foreign exchange, that's the forex market, is where currencies are bought and sold. It is decentralized market that operates 24 hours a day, enabling participants to exchange one currency for another. The forex market facilitates international trade, investment, and speculation with participants, including banks, corporations, governments, and individual traders.
All right, all right. Thank you so much, Stephen, for that. Asante. At least you've been able to take us through the 5, the over-the-counter, which is a decentralized database. We have Esther Mtash pale amenua mkono, wacha tusikie anasemaje. Esther Mtash, unasemaje?
Mwalimu, hi.
Yes, how are you?
I'm good. Where does Bitcoin belong?
Bitcoin belong under the forex market.
Huh?
It belong under the forex market.
Okay.
Yeah, it belong under the forex market because under the forex market you find these we call them virtual currencies or virtual assets. Virtual assets.
Mm-hmm.
Yeah, it belong there. Even the system, the system that is used there is the blockchain technology, and that's why even the supervision it operates 24 hours.
Thank you.
All right, sawa. Good. Okay. Now, from the over-the-counter market, these are it's like an open market whereby the buyer will be able to interact directly with the seller. There are no much regulations as compared to these organized markets. So the opposite of over-the-counter is organized market. Organized market is a centralized exchange whereby there are some regulations. Before you get to the seller, you have to follow some process. There are some process before you get to that seller. Then derivative market, this one is just a market that deal with the financial instrument derived from underlying asset, and these financial instrument ni kama future contract, options, swaps, forwards that help you can hedge. Hedge ni kama kushika. You can hedge interest over a certain asset, and you will be able to take advantage, because once you do the hedging, that interest rate will not change due to factors like inflation. So that helps you to at least be able to pay the loan, kama ni loan umekopa, with the same interest that you borrowed with. The interest will not be affected by the inflation. Mortgage market and forex market like that. So Tim, we have something which is very important when you talk about Nairobi Security Exchange. Of course, those people who are outside the country, Uganda wako na nini yao, Security Exchange yao, Southern Sudan wako na, kila country iko na yake. Now, it is the primary security exchange in Kenya, and its role and function are similar to other security exchange in different jurisdictions. So, here in Nigeria, laws ni zile zile. An overview. Laws and functions of Nairobi Security Exchange. Facilitating trading. Facilitating trading. There is a lot that happened under NSE. There's a lot that happened there. People are getting money from NSE. People are getting money from NSE. Price discovery. We have liquidity provision, investor protection, market surveillance. Market surveillance. So NSE, it's like we can call it an authority that guide traders, an authority that covers. It's an umbrella which covers the traders or investors. It's an umbrella. It acts as an umbrella. So we're not going to look at these security exchange terminology, the ticker time, the trading session, the market order, the limit order, security exchange listing. That one we're not going to look at it. Let's look at cross-border listing, which refers to the listing of securities on multiple exchanges across different jurisdictions. It allows companies to access a wider investor base and enhance their visibility. Cross-border listing require compliance with a listing of the requirement, with the listing of requirement and regulations of each exchange, each exchange. From there, I want us to go direct to where we have these are just the indicators, indices, the market, wale watu wanafanya trending kwa Bitcoin, you know, those indicators. Tukiwa na bullish, when we are at the bearish, when the candlestick is red, you know what it means. When the candlestick is green, you know what it means. When the candlestick is green, we are very happy. When the candlestick become red, we panic. We panic because at that point, mambo inaweza fanyika. So central depository system and automated trading system. Central depository system and automated trading system, CDS and ETS. The central depository system and automated trading system are important components of modern financial markets. Here are overview of each. We start with the CDS. Is a centralized electronic system that facilitates the holding, transfer, and settlement of security. And that's why when it comes to trading, these are virtual assets. Okay, the owner, the seller, and the buyer, they are secure. They are secure because we are having something we call escrow, which helps to hold the asset of the owner. And once the owner receives, the seller receives money from the buyer, now the escrow is able now to release the asset to the buyer. So it is a safe system. It's holding, transfer, and settlement of security. It replaces the traditional method of physical certificates with electronic records of ownership. The CDS provide a secure and efficient infrastructure for the settlement of trade in the financial market. What are some of the features and functions of the same? Security custody. Tumesema kuna hiyo escrow. Ukiulizwa escrow, hiyo ndio feature yenye iko kwa hizi platform, inasaidia kushikilia zile assets before the buyer send the money to whom? The money to the seller. And after that, the asset will be released to the buyer wallet. Security transfer, settlements, corporate action, investors service. So Esther Mtash, kindly take us through the ATS. Hapo kwa ATS, you can just take us through.
Automated trading system. The automated trading system, also known as electronic trading system or electronic communication network, is a computerized platform that facilitates the execution of securities trades. It enables investors to place orders, match buy and sell orders, and execute trades electronically. Key features and functions of the automated trading systems: order placement, order matching, transparency, speed and efficiency, market surveillance, timing of investment at the Measure.
All right, so
Or
you just proceed with the timing. In fact, under this timing, I wanted you guys to take your time and look at the Doe theory and Hatch system of timing. Those two theories, wakati during your own free time, please go through it. Go through it and understand that theory. Just proceed with these other parts down here: financial institutions and intermediaries. Mtash, just continue with this part.
Yeah. Okay. 3.7.
Yes.
The financial institutions and intermediaries, that is commercial banks, savings and loans associations and cooperative societies, foreign exchange bureaus, unit trusts and mutual funds, insurance companies and pension firms, insurance agencies and brokerage firms, investment companies and investment banks and stock brokerage firms, microfinance institutions and small and medium enterprises. Financial institutions and intermediaries play a vital role in the functioning of the financial system. An overview of some key financial institutions and intermediaries, that is, commercial banks, savings and loan associations and cooperative societies, foreign exchange bureaus, unit trusts and mutual funds, insurance companies and pension firms, insurance agencies and brokerage firms, investment companies, investment banks and stock brokerage firms, microfinance institutions, small and medium enterprises. Small and medium enterprises are businesses that fall within a certain size range, varying by country. Financial institutions often provide specialized services and products tailored to the needs of small medium enterprises, such as business loans, trade finance, and advisory services. Regulations of financial markets. Central Bank of Kenya, CBK, or equivalent entity in other jurisdictions. The role of the central bank and the monetary policy of the central bank, Capital Market Authority, and the Insurance Regulatory Authority. Regulations of financial markets is crucial to ensure stability, integrity, and fair practices within the financial system. In Kenya, the Central Bank of Kenya, Capital Market Authority, and Insurance Regulatory Authority are responsible for regulating specific segments of the financial market. Central Bank of Kenya. The Central Bank of Kenya is the country's central monetary authority. Its primary role is to maintain price stability, promote a sound and stable financial system, and foster the stability and efficiency of the payment system. The key responsibilities of the CBK include monetary policy, currency insurance, banking regulation and supervision, foreign exchange management, monetary policy. Sorry.
Okay. Now this is the CBK, and those are some of the functions. And examiner can still come in and ask you about the functions and also responsibility of the CBK and its characteristics. So the three, the CBK, the CMA, and the IRA are very important as far as the financial markets are concerned because they are the regulator. They are the regulator. So we have the monetary, Esther Mtash, you can take us through the monetary policy of the central bank. Monetary policy of the central bank.
Monetary policy of the central bank. The central bank's monetary policy refers to the actions and the measures taken by the central bank to manage the money supply and interest rates in the economy. Its main objective is to achieve price stability and support sustainable economic growth. The central bank uses various tools including interest rate policy, reserve requirements, open market operations.
All right. Thank you so much, Esther. Esther, that is very good. Asante sana. In fact, we are adding the next 4 minutes by 10:10 tutakuwa tunamaliza. Now, team, if it comes when it comes to the CBK, it is the umbrella of the other banks. It is the average the umbrella of other banks. So when it comes to the interest rate regulation on policies, all those reserve requirements, anything to do with the open market, anything that the market needs to understand, the CBK comes in on handy. Then we have Capital Market Authority, the CMA, which regulate and supervise the capital market in Kenya. All the regulations are given by the Capital Market Authority. Its main objective is to promote investor confidence, protect investors' interests, and ensure fair, efficient, and transparent operation in the capital market. The key responsibility are 1, market regulation, licensing and supervision, investor protection. So for any market, the person who is going to evoke the license is the CMA. That's authority, the one which can evoke the license. Insurance Regulatory Authority. Now, Insurance Regulatory Authority is responsible for regulating and supervising the insurance industry in Kenya. Its key objective include promoting and the development and stability of the insurance sector and protecting the interests of the policy holder. All right, the key responsibility are licensing the supervision, then policy holder protection, market development. So these purposely act on the interest of the insurance or the policy holder insurance or the policy holder. Factor responsible for the rapid development of financial institutions and market. What has led to development of these financial institutions? So we have economic growth and stability that has really led to the growth of these financial institutions. Technology advancements. Nowadays, technology has gone, it has just changed most of these sectors. Financial liberalization and deregulation, globalization and cross-border, we can now get technology or get some ideas from all over the country. It is very easy. So there is no border or boundary that is hindering us to do the development. Regulatory and legal framework, financial institution initiative, investor confidence and trust, skilled workforce and human capital, infrastructure and market support. We also have government support and policies. So class, if this is brought in your exam, please remember that we have government support, we have skilled workforce, investor confidence and trust. Those are some of the things that has led to the development of the financial institutions. Then we have some risk facing financial institutions. Risk will always be there, And when you ask about the risk, we have very many risks that you can mention. Credit risk, wakati umekopesha watu wamekosa kulipa. Market risk, you don't know what will happen tomorrow to the market, and you have your virtual assets, ujui what will happen to the interest rate, what will be those people who are holding more assets say, because that still go with the behavior of those people who hold more assets, where you also have some share. Then liquidity risk, operational risk, interest rate risk. We have compliance and regulatory risk, reputational risk, cybersecurity, whereby people are able to hack those systems and they are able to steal some of those assets. We have sovereign risk and systematic risk. By the way, we said systematic risk affect one company or more than one. One company or more than one. Acha nione mwenye nakumbuka. Systematic risk. Does it affect one company or more than one? Systematic. This one, we looked at it. And under topic 11. It is more than one, right? Because unsystematic. What how? Is it more than one or? Kindly, can you go and remind yourself? Can you go and remind yourself? Remember, we say that you need to draw a graph showing the systematic and unsystematic risk. Systematic and unsystematic risk. So, class, as far as that part is concerned, that's the end. That's the end. And we will be able to complete topic number 11 on Tuesday when we meet. On Tuesday, God willing, we shall be able to complete topic number 11, topic number 10, and then I'll know we will be able to look at the other theory part. The other theory part, tulisema hizo zingine, they are very short and we will be able to finish them. So by next week, most probably by Friday, tutakuwa almost done na hiyo wiki ingine. It will be revision kabisa up to the end, up to the time you'll be doing your paper. I know it will be on a Thursday afternoon, and for sure, I know that you're going to make it. So start believing in yourself, and that is marking the end of our today session. Allah, Friday ni holiday tena. Oh, okay. We shall have, of course, sasa hiyo tutakuwa tumemalizana na computation. Tuesday, we are going to finish on the computation. Then Friday, we can meet for the theory, the remaining part. Topic number 12, Islamic finance. Topic number 13, that is application, personal financial management, how you manage your finances. Then the other one, which is contemporary issue. Hiyo inachukua dakika 10. Tuangalie what is cryptocurrency, what is blockchain technology, crowdfunding, and that is done. So on Friday, tunaweza kuwa tutamaliza hiyo party yote. So next week, hiyo tunamaliza. Hata ni kesho, wiki ya kesho. So Tuesday, all computation done. Kindly don't miss. Asanteni sana. Allow us to end it at that time. I take the opportunity to thank all of you for making it to our today's session. Otherwise, I know it's not easy. It's a sacrifice. Nashukuru sana na mkuwe na wakati mwema. Have a blessed night until Tuesday evening. Asanteni. Goodbye. Unless kuna swali, we end it at that point.